I need you to pause for a second, not because of what gold is doing right now, but because of what's about to happen to it. Here's the current picture. On June 6th, gold closed at around $4,335 per ounce after taking a serious hit from the May jobs report, dropping from $4,580 just the day before. That's a punishing two-day move. And while most of Wall Street is laser-focused on that pullback, they are completely overlooking the deeper story developing beneath the surface. A story that one jobs number cannot derail, a story that has been quietly building for more than 50 years and is now in the final stretch before it explodes into the open. Here's the setup. The United States government officially carries its gold on the books at $42.22 per ounce. That's not a mistake. $42.22. That figure has not been updated since 1973. Meanwhile, gold is changing hands at $4,335 on the open market today. That's a discrepancy of roughly $4,300 per ounce, a $4,300 fiction sitting right there on the official government balance sheet. And now, for the first time in half a century, the people at the highest levels of the U.S. government are openly discussing correcting that fiction. Trump has publicly called for an audit of Fort Knox. Treasury Secretary Scott Bessent went on camera at the White House earlier this year and told the world the administration is planning to, quote, monetize the asset side of the U.S. balance sheet. He was smiling when he said it. The kind of smile that suggests he already knows exactly what happens next. What happens next is a gold price reset. And based on what we're going to cover today, the historical precedent, the math, the $39 trillion debt problem, the 4-month window, this may be the single most consequential financial development happening anywhere in the world right now. This is OG John AG. Today, we go deep on the Trump gold reset. Let's get into it. Part 1. The numbers that don't add up, and why they're about to change. Let me lay out the complete picture of what we're actually dealing with here. Because until you see the full set of numbers, the word reset sounds like fringe thinking. Once you see the numbers, it sounds like basic arithmetic. The United States officially holds approximately 261 million troy ounces of gold, the largest sovereign gold stockpile on the planet. According to Treasury records as of April 30th, 2026, Fort Knox alone holds 147.3 million of those ounces, roughly 4,580 metric tons, sitting in a vault in Kentucky. At the official government book price of $42.22 per ounce, the frozen 1973 statutory rate, those 261 million ounces are officially recorded as worth about $11 billion on the U.S. balance sheet. At today's market price of roughly $4,335 per ounce, that same gold is worth approximately $1.13 trillion. Let that land for a moment. The U.S. government is sitting on $1.1 trillion worth of gold and has it listed on the books as $11 billion. The difference, over $1.1 trillion, is essentially invisible on the official balance sheet. An asset the size of France's entire economic output, valued at the price of a moderately successful startup. And here's why this actually matters right now. The United States is currently carrying approximately $39 trillion in debt, growing by roughly $2.6 trillion per year. Interest payments alone now exceed $1 trillion annually, over $3 billion every single day. The government is now borrowing new money to cover the interest on money it already borrowed. That is not a sustainable arithmetic reality. Everyone in Washington understands this. The question has always been, what do you actually do about it? There are 4 paths. Raise taxes, politically toxic. Cut spending, politically toxic. Print more money, fuels the inflation that voters feel every time they check out at the grocery store, and Americans have been living with that pain for 3 straight years now. Or, the 4th option, the one that has never been fully deployed in the modern era. You mark up an asset you already own to its actual worth. You don't print anything new. You don't tax a single person. You don't take on any new debt. You simply correct a number on a spreadsheet to reflect reality. And instantly, over $1 trillion in value materializes on the government's balance sheet. That is exactly what Bessent was describing when he said monetize the asset side of the balance sheet. And that phrase, stacked on top of the Fort Knox audit push, is not random background noise. It is the early signal of something far larger that is coming before year's end. Part 2. We've seen this movie before, and we know how it ends. Here is the piece of this story that should put any doubt to rest about whether a gold revaluation is even feasible. It's not a theoretical exercise. It has already been executed in living memory under a strikingly similar set of circumstances. The year was 1933. The United States was deep inside the Great Depression. The government was drowning in debt relative to available resources. The banking system was teetering at the edge of collapse, and gold was sitting on private balance sheets at a price of $20.67 per ounce, a figure that had not been revisited in decades. On April 5th of that year, President Roosevelt issued Executive Order 6102. The order required every American citizen, bank, and institution to turn their gold over to the Federal Reserve by May 1st, in exchange for the official rate of $20.67 per ounce. Most complied. By May 10th, the government had taken in $300 million in gold coins and $470 million in gold certificates. Then came the next act, the one that most history books gloss over, but that every serious gold investor needs to understand deeply. On January 30th, 1934, just 9 months after acquiring the public's gold at $20.67 per ounce, Roosevelt signed the Gold Reserve Act. And the very next day, he repriced gold to $35 per ounce. Think carefully about what that sequence actually means. The government purchased gold from the public at $20.67, then immediately repriced it at $35. The overnight paper profit was used to capitalize the Exchange Stabilization Fund and significantly reinforce the government's balance sheet. Citizens who held onto their gold and refused to hand it over kept that revaluation gain. The ones who complied received $20.67. That's the lesson. The people who understood what was happening and acted before the announcement, not after it, came out on top. The sequence in 1933 and 1934 was audit the reserves, secure the asset, then reprice. The sequence unfolding right now is audit Fort Knox, confirm the reserves, then reprice. The playbook is identical. The only thing that has changed is the scale. Part 3. Why now? The 4-month window. Many people have been aware of the $42.22 book value problem for years. So the question every serious analyst is wrestling with is, why 2026? Why is this conversation happening now and not in 2015, 2019, or 2022? The answer is a convergence of 4 distinct forces, all pointing at the same narrow window in time. Factor 1. The debt math has become impossible to dismiss. The U.S. has always carried debt, but there was always a working assumption that the country could grow its way out of it. That story is running out of runway. Interest payments are now exceeding Medicare spending, exceeding the defense budget, and on current trajectory, debt service alone could approach $2 trillion annually before the decade closes. At some point, the creative solution has to come from something real, and the most elegant option available, the one that requires no new money printed, no taxes raised, is marking over $1.1 trillion in gold to its actual market value. Factor 2. Bessent said it publicly. Treasury Secretary Scott Bessent told the White House in early 2026, on camera, that the administration intends to monetize the asset side of the U.S. balance sheet and put those assets to work. He called it exciting. Bessent is not a dramatic man. When a sitting Treasury Secretary delivers those words at the White House podium, they are not improvised. They are chosen. They carry meaning. And the gap between gold's book value and its market value is the single largest monetizable asset sitting on that balance sheet. Factor 3. The Fort Knox trigger. In late May 2026, federal agents raided the home of a former CIA official in Virginia and seized 303 gold bars, roughly $40 million in metal, along with foreign currency and luxury watches. The arrest handed Trump the political justification he had been building toward for months. He went to Truth Social within hours. It is time to conduct a physical audit of Fort Knox. That post has received remarkably little attention from mainstream financial media, who are still chasing the jobs report. But that post is the clearest signal yet that the audit is no longer theoretical. The machinery is in motion. Factor 4. The 4-month window. Kevin Warsh's first FOMC meeting is June 16th and 17th, 10 days from now. His dot plot sets the tone for monetary policy through the rest of 2026. The CPI print coming next week is expected to show headline inflation climbing from 3.8% to roughly 4.2%. Midterm election positioning kicks into high gear after the summer. A gold revaluation, which immediately improves the government's debt-to-assets ratio on paper without touching a single line of spending, is enormously appealing as a political headline heading into midterm season. Stack those four factors together: an unworkable debt trajectory, a Treasury Secretary who telegraphed the move, a politically convenient Fort Knox moment, and a ticking election clock. The window is not 2030. The window is the next 4 months. Part 4. What a reset actually looks like, and what price they're targeting. Let's talk mechanics, because I want to be straight with you about what a revaluation actually does and doesn't accomplish. If the U.S. reprices its 261 million ounces of gold from $42.22 to, say, $5,000 per ounce, the paper gain on the balance sheet is approximately $1.3 trillion against a $39 trillion debt load. That is not a cure-all. It's not supposed to be. It is one instrument in a much broader toolkit that also includes sovereign wealth fund creation, tariff revenue, spending adjustments, and economic growth. But here's what that $1.3 trillion actually does. It materially improves the government's debt-to-assets ratio on paper. It gives the Treasury meaningful new collateral to deploy. It can serve as the seed capital for a sovereign wealth fund, an idea the Trump administration has been actively pursuing since early 2025. And as a political headline, Trump's gold strategy reduces national debt burden by $1.3 trillion. It is enormously powerful in an election cycle. So what price are they actually aiming for? Honestly, nobody outside a very small inner circle in Washington knows for certain. But there are logical boundaries. It has to be high enough to be meaningful on the balance sheet. At $2,000 per ounce, the gain is roughly $500 billion. Useful, but less impactful. At $5,000 per ounce, close to today's market price, the gain clears $1.3 trillion and begins to visibly alter the balance sheet picture. It cannot be so far above market price that it triggers a credibility crisis or sets off global alarm about dollar debasement. Setting an official price of $20,000 when gold trades at $4,335 would send shockwaves through every major central bank on Earth. The most likely target range, based on the balance sheet math and the 1934 precedent, is somewhere between $4,000 and $6,000 per ounce. The $5,000 level keeps appearing in analyst discussions for a straightforward reason. It is close enough to market reality to be credible, far enough above book value to be transformative on paper, and delivers a clean, headline-friendly floor number. Here is why the concept of a floor matters so much. When Roosevelt set gold at $35 in 1934, that price became the effective floor for nearly 4 decades. Gold didn't trade meaningfully below $35 until Nixon ended the gold standard in 1971, and then it ran to $800. If the U.S. government establishes an official price of $5,000 per ounce in 2026, that $5,000 doesn't just affect the balance sheet, it sets a new psychological anchor for the market, and historically, once a floor is officially established at the government level, prices tend to trade above it over time, not below. Part 5. What central banks are telling you without saying it. Here's a question most people never actually ask, but that tells you everything about where we are. If gold is nothing more than a relic, a shiny rock with no monetary relevance in the modern economy, why are the very institutions that manufacture modern money buying it at the fastest pace in decades? Central banks acquired a record 1,237 tons of gold in 2025, the third straight year above 1,000 tons. The World Gold Council projects 750 to 850 tons of central bank buying in 2026, still placing it among the top 5 years for official sector purchases since 1971. J.P. Morgan expects central bank buying to average 60 tons per month through the rest of 2026. Goldman Sachs revised their central bank tracking model upward after discovering they had been undercounting actual purchases. Poland is building toward a 700-ton gold reserve. China has been accumulating for 15 consecutive months. Saudi Arabia and the UAE are reportedly exploring significant allocations for the first time. New entrants, Indonesia, Malaysia, who sat on the sidelines for years, are now walking through the door. These are not retail traders responding to YouTube recommendations. These are the most powerful financial institutions on the planet, the entities that literally control the global money supply. And they are rotating out of paper and into gold at a historically unmatched pace. There is only one coherent explanation for that behavior. The people who create money are choosing to hold something that cannot be created. They are acting as though they expect the purchasing power of paper currencies to erode relative to hard assets over the coming decade. They are, in effect, casting votes with their balance sheets against the long-term stability of the existing monetary framework. And what they are buying is the exact same metal that the U.S. government currently has booked at $42.22 an ounce. When the institutions that print currency are buying that metal at $4,000 plus, and the government's records say it's worth $42, one of those numbers has to give. And government records can be corrected with a single keystroke. Market prices cannot. Part 6. What this means for gold's price. The math. Let me put some concrete numbers around this. Gold is sitting at approximately $4,335 this weekend after Friday's jobs report took a sledgehammer to it. It has pulled back significantly from its all-time high above $5,400 earlier this year. Goldman Sachs has a $5,400 year-end target and has held that call through every correction this year. JP Morgan sees gold pushing toward $5,000 by Q4. The 52-week range has been $3,248 to $5,595, which illustrates exactly how volatile the moves have been in both directions. Now consider what a formal government revaluation adds to that picture. It does not need to happen for gold to move higher from here. The structural case, central bank accumulation, debt debasement, persistent inflation, erosion of dollar credibility, supports gold at $5,000, $6,000, and beyond entirely on its own. Goldman's base case already puts gold at $5,400 by year-end, without factoring in any official revaluation. What the revaluation adds is a floor mechanism, a hard, government-endorsed price below which gold becomes extraordinarily cheap relative to an official U.S. government valuation. If Washington sets the book price at $5,000 and gold subsequently pulls back to $4,000, that spread creates enormous buying pressure from institutional players who understand exactly what the gap represents. And here's the piece that is genuinely underappreciated in almost every piece of coverage on this topic. The announcement of a revaluation, the moment it becomes official, does not nudge the price higher. It moves it immediately and permanently. Look at what happened in 1934, the day Roosevelt signed the Gold Reserve Act and lifted the price from $20.67 to $35. That was a 69% overnight increase in the official gold price. The market had no time to position. It was done. Nobody announces a revaluation in advance. If Bessent had stood up on camera and said, "We are planning to reprice gold to $5,000 next quarter," gold would trade above $5,000 before the words finished echoing, and the revaluation would lose its entire balance sheet impact. You do not announce the exact timing. You build the conditions. You move the pieces quietly, and then you drop the hammer. That is the asymmetry here. If you are positioned in gold before the announcement, you wake up one morning to a new official price. If you are waiting for the announcement to act, you are buying after the floor has already been set. Part 7. The honest risks, because you deserve both sides. I'm not going to be the channel that only walks you through the upside and buries the downside. That's not analysis, that's salesmanship. So here are the genuine risks. Risk 1. Confiscation. The last time the U.S. government executed something like this, in 1933, it first required citizens to surrender their gold at the old price. Roosevelt collected gold from the public at $20.67, then repriced it to $35. The people who held physical gold outside the banking system were not confiscated in large numbers. Only one person was ever actually prosecuted under Executive Order 6102. But the legal authority to do so existed. Could it happen again? The legal landscape today is different. The Gold Confiscation Act of 1933 was repealed in 1974, and Americans have had the unambiguous legal right to own gold for over 50 years. But if gold suddenly becomes central to repairing a $39 trillion balance sheet, the political calculus around private ownership could shift in ways nobody currently anticipates. The risk is not that the government shows up at your door. The risk is that ETFs and pooled accounts, paper gold held in institutional vaults, are subject to force majeure clauses, cash settlement, and regulatory reclassification in ways that physical metal you hold yourself simply is not. Risk 2. The revaluation gets pushed back. Midterm elections face delays due to geopolitical developments. The Iran situation escalates further and dominates the entire political agenda. Bessent's internal coalition fractures, and the plan stalls. The window shifts from 2026 to 2027 or later. In that scenario, gold keeps trading on its own fundamental merits, which remain strong, but the floor-setting catalyst does not arrive on the timeline I've described. You are not wrong long-term. You are just early. Risk 3. Dollar panic. If the revaluation is read not as a sophisticated balance sheet maneuver, but as a desperate acknowledgement that the dollar is losing its global reserve currency status, it could trigger a confidence crisis rather than a stabilizing event. Foreign holders of U.S. Treasury bonds could accelerate their dollar diversification. The dollar index could sell off aggressively. This scenario is less probable because Washington has consistently shown it can manage financial narratives effectively. But it is not off the table. My honest probability weighting? The revaluation happens in some form within the next 4 to 6 months. I put that at 60 to 65%. It gets delayed into 2027, roughly 25%. It doesn't happen in this form, but gold moves higher on its own structural fundamentals regardless, 10 to 15%. In all three scenarios, gold is structurally supported. The bear case is not that gold falls back to $2,000. The bear case is that gold grinds its way to $5,000 over 2 years instead of getting there in 2 months. Part 8. What gold holders should actually do, practically speaking. The most important question here is not what price gold eventually reaches, it's how you are holding it. Because that distinction is going to matter enormously in any scenario involving a government revaluation. Physical gold that you hold directly is the most sovereign form of ownership available. It cannot be cash settled by a counterparty. It cannot be frozen. It cannot be confiscated remotely. It is not subject to the force majeure language buried in the fine print of ETF prospectuses and bank precious metals programs. When a government sets a new official price overnight, the person holding physical metal wakes up to the new reality. The person holding an ETF wakes up to whatever their financial institution decides to do about it, which may or may not be the same thing. This does not mean ETFs are worthless or that every allocated storage program is fraudulent. It means that in a revaluation scenario, where the whole point is a sudden, significant change in official pricing, the counterparty structure of your holding matters more than it normally would. Second, this is a long-term position, not a trade. The people who multiplied their wealth during the 1970s gold run were not the ones trying to nail every peak and trough. They were the ones who grasped the structural case, sized their position honestly, and sat through the volatility. Gold ran from roughly $35 in 1971 to $800 by 1980. It did not move in a straight line. It had violent 30% and 40% corrections along the way. The people who sold during those drawdowns missed the entire move. Third, position sizing. If gold represents more than 15 to 20% of your liquid net worth, you are carrying concentration risk that this market's volatility can turn into a psychological breaking point at the worst possible moment. If it's under 3%, the revaluation won't meaningfully change your life either way. The right number is personal. Whatever it is, make sure it reflects your actual risk tolerance, not just your current enthusiasm for the thesis. Outro. Here's where things stand today, June 6th. Gold is at approximately $4,335, sharply lower after Friday's brutal jobs report, but still up roughly 65% from a year ago. Fort Knox holds 147 million ounces of gold that the U.S. government officially books at $42.22 per ounce. The real value at today's prices is approximately $640 billion for Fort Knox alone, and over $1.1 trillion across total U.S. reserves. Trump has publicly called for a Fort Knox audit following the seizure of $40 million in gold from a former CIA official. Treasury Secretary Scott Bessent is on record discussing the monetization of the asset side of the balance sheet. The U.S. is carrying $39 trillion in debt, with no clean exit that doesn't involve either pain or creativity. The 1934 Playbook is not distant history. It is the only time in the modern era a government faced this exact combination of circumstances: unmanageable debt, declining monetary credibility, and a massively undervalued gold reserve. And the mechanism it reached for was a sudden official revaluation that nobody outside a tiny inner circle knew was coming until it had already happened. Central banks bought 1,237 tons of gold in 2025, the third straight year above 1,000 tons. Goldman Sachs has a $5,400 year-end target. JP Morgan sees $5,000 by Q4. Both targets were constructed without assuming any formal revaluation. If the revaluation comes, those targets become floors, not ceilings. The question is not whether gold is a sound asset. That question has been answered by the data. The question is whether you are positioned, in the right form, at the right size, before the announcement that nobody will see coming until the morning it's already done. Because when Roosevelt signed the Gold Reserve Act on January 30th, 1934, he signed it in the morning. And by that afternoon, the official price of gold was 69% higher than it had been at breakfast. They don't announce it first. They do it. And then it is done. I'm OG John AG. The data is the edge. Stay stacked. See you in the next one.